Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Good afternoon, James.
Hello, Jim. How are you?
We're good. Welcome to another podcast.
Yes, thank you.
Today we have a guest speaker who unfortunately was misled by time.
Someone did it, not me. So anyway, we want to introduce Shiloh from Flat Rock Funds. Hi, how are you, Shiloh? Thanks for joining us. We're glad you made it.
Great to be with you.
Shiloh, I like your shirt.
Oh, thank you.
I like that
Like
a
the
lot.
color?
Yeah, I do. Suits you well.
So Shiloh, tell us, where are you? As if I don't already know.
So I am in Miami. I just moved here a couple months ago, and still getting settled a little bit. But it's 80 degrees outside, and I'm enjoying the weather.
Yeah, we wanted you to make us envious.
Yes. After all, it's only going up to 35, I think, today.
It was a heat wave yesterday here in New Jersey. So did you move from the Northeast, New York, New Jersey?
So I lived in New York City for 15 years before moving down here.
And you had
this is just kind of changing it up a little bit. I wanted to change the pace, and it's a very healthy outdoor lifestyle down here. So it's going well so far.
Well, very good.
Shiloh, why don't you take a minute and just tell us a little bit about you and what you represent for our clients.
Sure. So I am the Chief Investment Officer of Flat Rock Global, and I have about 25 years of professional experience. I started off as an investment banker. I did that for 2 years, and then I really, after that, transitioned to the buy side, and I've been working with CLOs ever since. So a CLO is Collateralized Loan Obligation. It's a pool of senior secured loans that issue securities with those loans as collateral. I was initially a credit analyst, so my job was to pick the kinds of corporate loans that go into CLOs. I did that for a little bit over a decade. And then the last 10 plus years I've spent investing in CLO securities. I joined Flat Rock about 6.5 years ago, so I've been here for quite some time. And we manage 3 different funds. One invests in with a focus on private credit, middle market loans. One fund invests in middle market CLO Double-B rated notes, debt securities. And then our third fund is a CLO Equity Fund.
Okay. Now, Shiloh, I know you and I had spoken some time ago, but I'm not sure if you know that I have a number of my clients in most instances, probably all 3 of the funds, but predominantly your flagship fund, the income fund. Perhaps we could talk a little bit about each of the funds individually, how they work. I have to tell you, too, that I have a couple of clients that are in retirement, and they love the consistent income flow that they receive on a monthly basis from the funds.
Sure.
So, and I'm sure that's music to your ears to hear that. But as I said, I'd love for our listeners to be able for us to take a little bit of a deeper dive as to, how CLOs work and how the funds, each of them individually. So I'll let you take whichever one you want to start with, and maybe break it down a little bit, give us a little bit of how they work. And one of the other things that I want to point out too is typically we work with clients that are accredited investors, when we want to get them into the alternative space, but that's not an issue here. So I think it's also important for us to recognize one of the differences with alternative funds, but the difference with your funds as well is that is not going to be a hurdle that
Yeah,
people have to get over.
sure. So there's two. Let me hit kind of our firm DNA and the fund structure, and then I'll go kind of through the three funds and what we kind of see as their merits. So at Flat Rock, we started in business a little bit over 7 years ago. Today we manage about $1.3 billion, and so during that time, we've been growing at a really nice pace. But we consider ourselves at Flat Rock to be really investors, not asset gatherers. And so, there have been months where I've seen our competitors out there and they've raised, in some cases, $1 billion in a month or a quarter, and we look at that and it's kind of like, maybe that'll be good for the manager. But, we're hyper focused on our track record. We are hyper selective in the investments that we make. And so for us, we kind of like growing at this kind of, a nice pace, but a pace that enables us to be very selective in the investments that we make. In terms of the fund structure, all three of our funds are interval funds. And so these function a lot like mutual funds, except that the investments that we provide exposure to through the funds are illiquid. And because of that, we're not able to, if somebody wants to redeem shares, tomorrow and get their money back, we're not set up to do that. And so people can buy shares any day using our ticker, just like a mutual fund. But if they want out of the fund, what we do is we offer these 5% quarterly tenders, and basically how that works is it's either point or click, or send a piece of paper to us. We buy back shares at net asset value, so it's 20% that we buy back in each year. And how that's been working, 90+% of the time is that it'd be very unlikely in our interval fund or other people's interval funds that everybody's tendering at the same time, and so. Not 90% of the time when people tender, they get back 100% of what they put in for. And in the cases where they didn't get back 100%, they just waited another 90 days, another quarter, they tendered, and then they have 100% of their money back. So that's kind of the interval fund structure. We like it because we think it gives the end investor exposure to all these illiquid assets, but with a fair amount of liquidity themselves through our tenders. And so if you do our target securities through another format, like a closed-end fund, the experience that you're going to have is a lot of volatility in the share price. Potentially it'll trade below book value, which is negative for returns if you buy in the IPO or something. Or alternatively, you could get exposure to our same assets through a separately managed account or a GPLP fund, and that would really entail a commitment of 10 years. In our structure, really the commitment is just 90 days. And the way that we're set up is that we kind of, because the money that we've raised isn't permanent, we're constantly getting a report card from you, from our investors, because people can, again, buy shares any day. If they're not happy with the performance, they can tender. So we, again, our DNA is kind of hyper focused on this track record. So why don't I hit the three funds and kind of the strategy? So
yeah, before you do, Shiloh, before you do that, I just wanted to make one point for listeners so that they understand interval funds, which you kind of describe. Basically, you put a redemption in, and it's usually on a quarterly basis. But correct me if I'm wrong. A lot of these interval funds have one specific day that you can redeem, and you have to put in your request on that day. If you do it the day before or the day after, then you're going to miss it. if I recall correctly, you actually have a window of time. Is that right?
That's right. I think you can put in, check a box or click a box, and that whenever the correct day to tender is, it'll put your order in for the share repurchase.
Okay, good.
Nice.
All right, so go ahead. Please let us, as you were
Yeah,
beginning to describe the fund. So we're all ears.
sure. So the Flat Rock Core Income Fund is the fund that's been around the longest. So it's been around for about 7 years, and during this time period, much of which encompassed a time with very low rate, the fund did a 8% plus return over that time period. That's 8%, every year on average. And basically, the strategy is to own exposure to middle market loans. So these loans are created in leverage buyout. So imagine Ares, Apollo, KKR. They're buying a company, and they only put up 50% of the purchase price in equity. And the remainder is going to come from a first lien loan, and that's going to be underwritten by one middle market manager or clubbed up, if you will. So have a few different lenders in there. And so the profile of this loan is, to a company that's private equity backed. And so it's not, your local laundromat or pizzeria or gym. These are established U.S. companies with, call it 100 plus million of revenue. The loan to value starts off at about 50%, so 50. So that means the enterprise value of the business could decline by half, and you're still theoretically money good on the loan. And then these loans pay a floating rate of interest in our market. SOFR, the secured overnight financing rate, is the floating rate. That's very closely tied to Fed funds. And so it's kind of SOFR plus today about 5% is what you earn. And so the yields on these loans are in the kind of high single digits, maybe it's 9%. And we think that 9% is a good potential return because these loans default rarely. And because you're first lien and you're senior secured, when they do default, historically, the recoveries are quite good. So around 65 cents on the dollar is kind of the average recovery looking back over 30 years. So because the Fed has hiked so much, really beginning in 2022, we think these loans offer equity-like returns with a fair amount of downside risk. And that's why we've seen a lot of inflows into the fund. And we've also seen, competitors in our space. Private credit is, something that's like in the news quite a bit now. And that's because of how popular it's become.
Very good. Shiloh,
So,
excuse me, if an investor wants to look at this, I'm assuming it has to have some form of an accredited investor. And is there a minimum, or is it just like any other mutual fund out there or ETF?
yeah, so it's just like any other mutual fund or ETF. There's no minimum and there's no accreditization.
Nice.
So we try to make it easy. Yeah.
Okay. I'm sorry, I didn't mean to interrupt you. So please, there's two more funds.
Yeah, sure. So that was, in terms of the three funds, that was the lowest return potential and the lowest risk. And then I'm going to hit the other kind of bookend here and do the higher risk, higher return potential. So that's CLO equity. So basically a CLO is going to be a pool of these middle market loans. There might be 100 or so pooled together, and the CLO finances itself with long-term debt that's sold to insurance companies and banks. And then we're an investor in the equity tranche of these CLOs. And so what that means, the risk we're taking, is that when loans default, that's like going to be a hit, or that's the risk for the equity. And the reason that we think that's a good risk is that the CLO is very profitable. So the yield on the loans that the CLO owns is much higher than the CLO's financing cost. So think of it kind of maybe similar to a bank. The bank's making loans at a higher rate than its financing cost. That creates this quarterly profitability for the owners of the CLO equity, and so they get a distribution every quarter. And the distribution rates today are quite high, so it's like very high teens to 20%. And what we do when modeling our CLO equity positions is, because there's 100 plus of these loans in the CLO, we know that not all 100 loans are going to be money good at the end of the day. And so if you look back over the last decade, we, by our estimation, 2% of the loans default each year. The recovery is a little bit short of 70 cents on the dollar. And so we factor in that loss rate into all of our modeling assumptions. And so there is this loan loss reserve, if you will, and net of that loan loss reserve. So after baking in this 2% default rate on the loans, we expect to earn returns in the kind of mid to high teens. And so that's the attraction of CLO equity. Our fund there has about 450 million of AUM. We've done a little bit over a 12% return since inception 6.5 years ago. But clients find that one interesting because the return of the fund has trailed the S&P 500 during this time period by about 200 basis points. But in CLOs, unfortunately, there's no enthusiasm for AI. As you guys know, a lot of the return of the S&P 500 is a handful of stocks. And if you didn't make the right call, maybe you didn't get the full return of the S&P 500. Maybe you did better. That's also possible, of course. But our fund has a third of the standard deviation of the S&P, and so S&P is volatile. During the COVID period, our fund was down 22% peak to trough. The S&P was down 35, 36. So it's just different risk profile, but it still generates what we think are very healthy equity-like returns. And then that structure, again, it's like, for all three of our funds, that's the interval fund structure that we talked about. And by the way, our funds are only available through RIAs. So they're not, the investors can get exposure through advisors like yourself. But, your average, person can't buy it on E-Trade or Schwab or anything like that.
Yeah. Yes, that's excellent. Which fund is this? Just so that people
So that's the Flat Rock Opportunity Fund.
The Opportunity.
So the ticker is FROPX.
Right. Okay.
And the first fund that I mentioned is the Flat Rock Core Income Fund, and that's ticker CORFX.
Right. Okay. This is good. Just before we get into the third and final fund, which I guess you view as the middle fund as far as the rates that they're each generating, you mentioned it's private equity, but what do you have a profile of the types of companies that you look to?
Sure. So at Flat Rock, we are not a CLO manager. So I mentioned there's 100 plus loans in the CLO. We hire third parties to pick the loans. If there's an issue with the loan, to kind of work it out through a restructuring. And the CLOs have a reinvestment period that's usually 4 to 5 years. So during that time, as loans repay, the CLO manager is replacing that with a new loan. And sometimes they do some kind of loan trading to make sure the portfolio is as optimal as possible. And so like at Flat Rock, our biggest CLO managers are going to be people like BlackRock, New Mountain, Barings, Guggenheim, a lot of the publicly traded Ares, a lot of the publicly traded alternative asset managers. have CLO management teams, and that's who we work with on our CLOs. So they put together that initial loan pool, and then as a CLO analyst, my job is to, at least initially in the CLO, work with the manager, go through the 100 plus names that are in the portfolio. We don't, we're not going to ask the manager about all 100 loans. I don't think that's would be a good use of anyone's time. But what we do is we look for loans that might be outliers for some reason, like the loan looks like it has more leverage than the average loan in the pool. The loan might be rated triple C instead of single B, which is the more common rating in CLOs. So sometimes when we look at the loan pool, we come away with some questions, and then that becomes part of the due diligence process that we do with the CLO manager.
Okay, that's very insightful and important information. Jim, do you have any questions before he goes into the last fund?
No, keep going. I'm liking what I hear.
Great. Okay. So our third fund is the Flat Rock Enhanced Income Fund. So it owns middle market CLO Double-B notes. So these are of the CLOs securities that are issued. The senior most is the AAA, but the CLO issues, all the way down the stack. So AAA, AA, single A, triple B, and then double B, and then usually equity after that. Although sometimes there's a single B. So all kind of ratings are issued, and in this fund we own the double B. So that's usually the junior most debt tranche that's issued by the CLO. And so today we earn rates on these middle market double Bs of 3 months SOFR. Again, that's the floating rate for my market, plus about 8%. So yields today are about 12.5%. And then if you look back over the last 30 years, these CLO double Bs default at a rate of about 25 basis points per year. So we think that kind of the risk return that you get in CLO double Bs is about as favorable as you can find really in any market. And I do think the CLO Equity Fund offers higher potential returns. But again, if you're going for risk-adjusted return, CLO double Bs fit they work well for lots of investors. And so we launched this fund 2 years ago, a little bit over 2 years ago. We have raised $450 million in the strategy, and advisors like it because they tell their end investors, you can get exposure to middle market loans through CLO technology. But the unique selling point is that if you own loans directly on your balance sheet, for example, the trade or the investment that you're making is that you get the interest income from the pool of loans. But when a loan defaults, that's the risk you're running, right? Well, in CLO double Bs, it's different because there's a CLO equity investor who signed on to take the initial risk of the loan portfolio. And so in equity, each time a loan defaults, if you own CLO equity, that's an issue for you. I mentioned that we are already budgeting to take defaults, so it's partially mitigated. But in the CLO double B, as loans default, it should be just a problem for the equity. And so again, there's this 25 basis point default rate historically, which is really kind of de minimis. And given where yields are today, people have been pretty excited about the fund.
This is the enhanced fund, right?
This is
Sean?
the enhanced income fund.
Right. Okay.
Yeah. And one of the things that has worked, I think for RIAs and clients on this particular fund is that for CLOs, it's I've been in this market for 20 plus years and understand it pretty well, but it's definitely more complicated than owning plain vanilla bonds or the S&P 500 or mutual funds, right? So there is a little bit of a learning curve for CLOs. And for equity, there's more CLO equity. There's some nuances to it. And I wrote a book on CLO investing that can help people. And like you guys, I have a podcast as well. So I have people come on and talk about whatever's kind of new in CLOs. But for the CLO Double-B, the education process is really, it's a pretty straightforward investment that we're making. So it's a debt investment. It's floating rate based on SOFR. The security that backs the Double-B is this diversified portfolio of middle market loans. Um, the Double-B might be bought at 99 cents on the dollar today. It goes away at par, 5 years from now or whatever it is. And it's just not, there's not a ton of nuances to it. CLO equity, a little bit more complicated. But for the Double-B, it's straightforward. And so a lot of times, I'm having a conversation, with folks like yourselves who are already sophisticated, explaining our funds. But then I know that there's kind of a little game of telephone, where you have to then explain, to the end investor. And for CLO Double-Bs, it's just it's really straightforward what it is.
Yeah. No, absolutely. And I've had some of your colleagues who've helped me to explain each of the individual funds to my clients who ultimately have invested, and as I said earlier, are very pleased and happy with the results so far. And in full disclosure, I actually also own some of the funds too. So
Oh, great.
I think I've contributed to the $450 million that in
Okay.
the fund. So
What
Good to hear.
percentage?
and no, they've done quite well, and we're going to continue to use them. And there's you've really helped explain a lot more than most people would understand. But this was very informative and very insightful. Jim, do you have any other questions?
Just, Shiloh, could you share with us the last ticker for that fund?
Sure. So the last ticker is FRBBX, the Flat Rock Enhanced Income Fund.
Awesome.
All right. We're just about finished. We have a little bit of time, so I would want to give you, Shiloh, the ability to just summarize in some highlight form certain things that we should be aware of and our listeners should be aware of as well.
Sure. So I think for CLOs, I mean, a big thing is really just kind of the education process. So I think that CLO securities have offered very attractive risk-adjusted returns for years, but there is an element of education that needs to be done. So in 2023, well, actually, going way back, even during the COVID period, I decided to write a 50-page kind of manual for how I go about doing CLO equity investing. And I put that on our website, and was really surprised at how many people read it and commented to me about it. And so that gave me the idea to just, have a full book. So then I kind of started writing to get to the, 200 plus pages of, what is now a book called CLO Investing with a focus on equity and Double-B notes. That's our specialty at Flat Rock. So I published that in 2023, and CLOs is $1 trillion asset class, but there was no book out there before. You could, if you wanted to learn about it, you could Google search and find different articles and kind of try to tie it all together. But this was designed to be the one-stop shop for all your CLO educational needs. And then once I did that, it seems like kind of, and you guys are onto this as well, but how people really want to digest information these days is it's probably not books, and it's probably not white papers or an hour of somebody lecturing from a podium. It's, conversations like this. So, I just kind of the friendly back and forth, the Q&A. I think it's how people want to get their information. If you're driving home on your commute, it's it's informative, but not just there's a kind of a human element to it as well.
It's a friendly version, right?
It's the friendly, yes.
Yeah,
It's the friendly version.
Shiloh, if somebody wanted to get your book, where would they go?
Yeah, a good question.
It's just on Amazon or Barnes and Noble.
Perfect.
Yeah.
Yep.
Well, it's going to be our new reading for the new year.
Yes, it is.
Yeah, I'm interested to see it and to read it. It would be give us even that much more information and insight.
I agree.
Sure thing. And then the podcast, I'm on episode 16 of mine, and kind of the genesis there is I just realized that during my week, I'm having a lot of conversations where, for me, it's just kind of the normal, update from a CLO manager or a CLO banker. And much to my surprise, I realized that people, do find these conversations to be quite interesting. So I'm enjoying doing the podcast because it's once you kind of figure out over a day or two how to get the technology and, how close to be to a mic and all these other things, that does take a little bit of learning. Once you get that, the great thing about a podcast is your guests, like me today, we do all the work, right? So you need a few good questions and kind of steer your guests. But I've really enjoyed kind of doing the podcast, and it's one thing that again has helped a lot of our investors just understand the market. So I told you earlier, that FlyRock is not a CLO manager, that BlackRock and New Mountain are our biggest CLO managers. And so if you want to know about the credit quality of the loans in CLOs, instead of asking me, which I'm happy to tell you, I'll have the CLO portfolio manager from BlackRock on, or New Mountain. So both have been my guests, and you can hear directly from them, what kind of loans are going into the CLOs and how they feel about them, how they source them, trends in credit quality. So it doesn't, you can hear it from me directly, or you can go straight to the horse's mouth. And, I think people are finding the podcast to be pretty interesting.
That's terrific. That's good. So you knew you had, unlike some of our previous guests who've not done a podcast, it was their first time. This was, you're a veteran.
Yes, we're experienced.
I think everybody's doing a podcast these days.
Yeah.
Well, we can't thank you enough, Shiloh, for coming on this late notice. And I'll take responsibility, Jim. It's my fault.
Okay, good.
No worries at all.
All right, Shiloh, thank you very much. We'll look forward to talking with you in the near future again, and perhaps coming back again as a guest.
Look forward
I'd love to do it. Really enjoyed our chat.
All right, wonderful.
Take care.
Bye-bye now.
Thanks,
Enjoy.
guys.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on investors' objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time based on numerous factors, such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bellpoint Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal loss is possible.